Now let's discuss various accounting concepts and accounting principles. We use these two terms simultaneously, but there is a difference between concepts and accounting principles. Accounting concepts is the basic concepts which is applied everywhere in accounts, and accounting principles are rules of accounts which can be changeable depending upon the situation and requirement. Let's discuss each and every concepts and principles in detail. Business entity concept says that business and businessman both are different from each other. Therefore, only business transactions are recorded in books of accounts. Businessmen's personal transactions are not recorded in business books of accounts. Hence, accounts are prepared from the point of view of business. Therefore, there is a term capital and drawings, because when businessman brings money into the business, it is capital. Businessman's personal money is brought into the business, therefore it is now become business money and not businessman money. So there is a difference between businessman personal money and business money. Similarly, drawings means when businessman withdraws money from business for personal use. So when businessmen withdraw money for personal purpose, we have to record as drawings. Capital is a liability for the business, because at the time of winding up of the businessman will take away that capital. So there is difference between business money and businessman personal money. So business entity concept says that there is a difference between business and businessman. Businessmen's personal transactions are different, and only business transactions are recorded in business books of accounts. Next is money measurement concept. It states that only monetary transactions are recorded in business books of accounts. Non-monetary transactions are not recorded. It means business transactions which can be identified in terms of money is recorded in business books of accounts in domestic currency only. For example, goods purchased worth rupees 20,000 rupees and goods sold to Mr. Y for $140. Here, both the transactions are recorded in terms of money, but both the currencies are different. So at the time of recording the transaction, we have to write in domestic currency only. If other currency is given, then we have to convert it into domestic currency and then write. So money measurement concept says that only those transactions are recorded in books of accounts which can be identified in terms of money. As we know that transactions can be classified into monetary transaction and non-monetary transactions. It means barter transaction, one goods for another. So non-monetary transactions are not recorded in business books of accounts. Only monetary transactions are recorded, and it can be further divided into cash transaction and credit transactions. So money transactions can be recorded in books of accounts in domestic currency only. Next is cost concept. It states that all the fixed assets are recorded at its cost price or historical cost or cost of acquisition. So fixed assets are recorded at its cost price and not market price. These cost price include purchase price, other expenses which are paid for installation, all the charges that are paid before using that fixed asset for the first time will be added to its cost price. For example, if purchase price of that fixed asset is 1 lakh rupees, cost of carrying the fixed asset to the factory is 10,000 rupees, installation charges paid 2,000 rupees, and other charges or other accessory charges are 1,000 rupees, then total cost price of the fixed asset will be 1,13,000 rupees, and this cost will be deducted every year as a depreciation. So cost concept states that all the fixed assets are recorded at its cost price or historical cost or cost of acquisition. It also includes other charges. Next is consistency concept. It means any policy adopted for account should be continue and consistent over period of time. It need not be changed unless and until situation demands. The accounting policy can be changed in following three conditions. First point, to bring books of accounts in accordance with accounting standard. Next, to comply with provisions of the law. And third, new method of accounting will reflect more true and fair view in financial statement. To bring books of accounts in accordance with accounting standard, if there is any change in accounting standard, or if previously business organization used to apply different method of accounting, but later on it realized that another method is more applicable and more realistic, then in that case business can change the policy to comply with accounting standards. Next, to comply with provision of the law. For example, in Income Tax Act, it states that some of the machineries are depreciated at reducing balance method and not at fixed installment method. So a business can apply that criteria into the business to comply with the other provision of the law. And if new method will reflect more true and fair view in financial statement. True and fair view means all the data under financial statement reflects correct amount with no human error, and financial statement means trading account, profit and loss account, balance sheet, and cash flow statements. So if new method of applying accounting system reflects more true and fair view in financial statement, then business can change the accounting policy. Otherwise, the method of charging depreciation or following any accounting policy will have to continue and consistent over a period of time. Let's take one more example. There are more than 30 methods of charging depreciation. Most commonly used are fixed installment method and written down value method. If business wants to change the method from fixed installment method to written down value method, then it can then there must be some explanation behind this. For example, depreciation on furniture is charged at written down value method, but later on it realized that for the performance of furniture is constant over the year, then the business can shift the method to fixed installment method, because new method of charging depreciation reflects more true and fair view. It reflects more practical view in accounting statement. So depreciation on furniture should be charged at fixed installment method, because the performance of furniture will be constant over a period of time. The depreciation on machinery should be charged at reduced balance method or return down value method, because the performance of machinery will be reduced over a period of time. For example, performance of laptop or computer will be reduced over a period of time. Similarly, the depreciation on vehicles should be charged on the basis of life of the vehicle, or we can determine the life of the vehicle on the basis of kilometers. Therefore, accounting policy should be continued and consistent over a period of time. Next is conservatism. It is also called as prudence, prudence principle. While recording transactions in books of accounts, we have to anticipate no profit but provide all possible losses. It reflects lower income and understate the assets and overstate liabilities. Hence, it encourages to create secret reserve by making provision to prevent future losses. This policy is asking accountant to play safe while recording transactions. One of the example of conservatism is recording of closing stock at cost price or market price, whichever is lower. It helps to reduce income and understate the assets. Next is going concern. It is the basic assumption of accounting. It shows that the business organization will continue its operation for future, and it is not going to shut down or liquidate in near future. Therefore, assets are recorded at its cost price, and increase and decrease in short term are ignored. For example, fixed assets such as plant and machinery or furniture and fixture are recorded at its cost price, and depreciation is charged every year. Similarly, outstanding expenses, outstanding income, prepaid expenses, pre-received income, all are recorded in books of accounts. Next, realization principle. Income is recorded at the time when it is realized, irrespective of the fact whether cash is received or not. For example, goods sold on credit to Mr. Ramesh. In this case, income is realized at the time of sales, but cash is not yet received. But still, the entry will be recorded as sales. Let's take another example. Advance received from Mr. X is recorded on liability side, and when income realizes, then we will record it into income side. Next, accrual concept. As we have discussed, income is recorded when it is realized. So, income is recorded when it is accrued or realized. It means when it is earned. We have taken example of credit sales. At the time of credit sales, income has been earned. So we have to record credit transactions, credit sales transaction. But cash is not yet received. Similarly, expenses are recorded when it is accrued or payable. So income is recorded when it is earned, and expenses are recorded when it is payable. It becomes payable, irrespective of the fact that income and expenses are received or paid in cash or not. So accrual concept. Next is dual aspect concept. It states that every transactions or events has two aspects or two events. Transaction means purchase, sales, rent received, rent paid, or salary paid, interest, dividend received, commission paid. All these are transactions. These are regular transactions. Purchase of goods, sale of goods, purchase of any assets, sale of assets, all these are transactions. Rent received or rent paid, salary paid, interest or dividend received, all these are transactions. And some of the transactions are regular transactions and some are non-regular transactions. But events are not regular. Events occur at the end of particular period. For example, profit or loss, or particular position of financial position of assets and liabilities. So it reflects financial position of business. So every transactions or events has two aspects or two effects. It means every debit has its corresponding and equal credit side. Therefore, it is called as double entry system of bookkeeping. Let's take an example. Businessman started business with cash of rupees 1 lakh. In this example, the journal entry will be cash account debit to capital account. So there are two aspects, 1 lakh rupees debit and 1 lakh rupees will be on credit side. So there are two effects involved. Cash is received into the business, and second is liability created. While we record capital account on credit side, it means liability has been created for rupees 1 lakh. Similarly, at the time of purchase, goods comes in and cash goes out if it is purchased on cash, and if it is purchased on credit basis, then liability will be created as a creditor. Sales, goods goes out and cash comes in. Rent paid. Rent is an expenditure. So rent expenditure is recorded and cash goes out. So cash payment will be recorded. Similarly, salary paid. Salary is expenditure. It is recorded as a transaction and cash payment will be recorded. So each and every transactions or events have two effects. Even profit and loss have different effects. For example, gross profit or net profit will be shifted to another account and ultimately balance sheet tallies. Let's take some examples. Machinery purchased in cash. In this case, fixed asset increases and current asset decreases. Machinery comes into the business, so fixed asset increases and cash payment is done, so cash goes out, current asset decreases. So one asset increases, another asset decreases. Similarly, If machinery purchased on credit, then fixed asset increases, but liability is also increases because money is payable. It is yet to be paid. So, in the first example, one asset increases, another asset decreases. In second example, when asset increases, liability is also increasing. Next, bank loan taken or loan taken from bank. So money comes in, cash comes in. So one asset increases, also liability increases because we have taken loan from the bank. And if bank loan repaid, then asset decreases and liability also decreases. So each and every transaction has dual effects. Next is disclosure. The accountant must disclose all material facts. The financial statement, that is financial performance and financial position, should disclose all the material information. It should be reliable, relevant, comparable, and understood by all. So, financial performance and financial position should disclose all material information. It is contrary to the full disclosure principle. Here, financial performance is reflected in profit and loss account, and financial position is reflected in balance sheet. Collectively, it is called as financial statement. It means trading, profit and loss, balance sheet, and cash flow statement. So, disclosure principle states that the accountant must disclose all the material facts which is relevant for decision making, which can influence decision making of any person. Similarly, materiality concept also states that the financial statement must disclose all the material information in the books of accounts. Those information which influences the decision making of any user is called as material information. If the information is not relevant or not significant, then the information is not material, the disclosure is not required. But if the accountant finds that any particular information is relevant and it influences the decision making of any user, then it should be mentioned in the books of accounts. For example, changing the method of depreciation from fixed installment to written down value method or vice versa. So the profit and loss amount will be different in either case. So it is required to be mentioned or disclosed in the books of accounts. The material information depends upon nature of business, size of business, nature and size of transaction, or amount of transaction. Next is matching concept. It states that all expenses should match with income of that period. Expenses incurred, it means whether it is paid or not. and income earned or realized, whether received in cash or not. So the expenses are paid on time or it is prepaid or it can be outstanding expense. So if it is prepaid, then the expense will be deducted from particular period, and if it is outstanding, then it will be added to particular expenses. The outstanding expenses are liability for the company and prepaid expenses are assets, current assets for the company. Similarly, on other hand, income can be pre-received or outstanding. If it is pre-received, then it will be deducted from particular income, and if it is outstanding for current year, then it will be added. But pre-received income are liability and outstanding income are current asset for business organization. Periodicity concept. As we know, going concern concept states that the business organization is going to continue its operation for longer period of time and it is not going to close down in near future or liquidate the business in near future, but the accounts are maintained for particular period of time, that is for a year. The accounts are recorded and maintained for particular period, that is accounting year or financial year, to know about the performance of particular period. Performance means profit and loss information. It helps to identify profit and loss for particular period and also to compare the performance and financial position of different periods. Accounting standards and international financial reporting standards. These are the set of rules that are applicable while recording financial transactions in books of accounts. The accounting standards are provided by ICAI, Institute of Chartered Accountants of India, and international financial reporting standards are provided by International Forum for Accounting. Some of the accounting standards have been merged into another accounting standard and trying to connect with IFRS. There are three basic accounting assumptions: going concern, consistency, and accrual. Going concern principle states that the business organization is going to continue its operation for longer period of time and it is not going to wind up or liquidate the business in near future. Consistency principle states that any accounting system or accounting method used for 1 year will be continuously and consistently followed for another year. Next is accrual principle. It states that the business transactions in books of accounts will be recorded on accrual basis. It means income are recorded when it is earned, irrespective of whether cash received or not, and expenses are recorded when it is payable. It means irrespective of whether it is paid or payable.